the first objective of this panel is to get you to your lunch, and which seems to me could put us at the top of the league in terms of achievements this morning, you know. What I thought we might do, since we haven't really had much chance to rehearse what we were going to do, so we're all up here sort of flying blind a bit, but I think we've all listened to what's happened this morning, and I think we're in a good position to try and sum up the, and perhaps put a few thoughts into people's minds as we go to lunch. The title of the panel is The Current State of Shipping Finance, Expectations, Experiences and Useful Tips. But I think we have a slightly different mix of experience in this panel from the previous one, which I think it's fair to say was more financial. We've got Macquarie, of course, but it was more financially orientated. Hopefully we've got some good practical practitioners here. And so I thought I might ask each of the panelists to briefly introduce themselves in case you out there you don't know them. I'm famous for introducing people wrong, so I'm not going to try and do that myself. And I still find some of your Greek names quite challenging, you know. But before we do that, what I'd like to do, Yori suggested I might sort of mention a few of the issues. He saw me writing notes this morning, and so just for 2 minutes I'll do that, and then perhaps we can go down the panel, and I think each of you can say what you think is appropriate in the circumstances, and then we'll have a bit of discussion at the end, if that's okay. This is not necessarily in any order, but Dr. Drobets, or Professor Drobets, mentioned that the shipping industry, actually the cheapest form of equity is internal equity. It's the company's own equity is the cheapest source. But he also put up a slide that shows that the shipping industry is a very heavily leveraged business. We have asset-rich balance sheets. And so there's an issue here, I think, right at the bottom of this question. If we have ship owners, the mid-sized ship owner, which I think was very much in the minds of the organizers of this conference, let's say somebody with 10 products tankers, 15 bulk carriers, the ones that the European banks are less interested in at the moment, frankly. I think I can say that, but if you don't agree, then put it. The question really is, are these owners who are currently finding it very difficult to raise money, should they be thinking also maybe of trying to work on a lower leverage level, and in so doing raise their credit worthiness and make themselves more accessible? That was the first thing I thought. The second thing was, having heard Yves' speech, I decided I really needed to go out and study IFRS 16, because it sounds like there is a new set of rules out there which you need to understand, and I'd be quite interested to hear what the panelists think about that particular issue. Cruz Chi told us that BOCOM does 70% of its business in Europe. I was surprised at that, in the leasing business and shipping leasing, and has an A- rating with S&P, and they are actually they're positioning themselves as partners to banks, not as prime financiers. I think that was my understanding, but perhaps he'll come in later if I've misrepresented that. But I was talking to leasing companies in Shanghai before Christmas and got the very firm impression that at the moment they're interested in billion-dollar deals. They were not so interested, and certainly the sort of lease-type structures tend not to be so interesting when you're doing $100, $200 million, which is what the mid-sized company might want. I think the other thing which Yves said was that you should talk cash, not assets. because of the problems there. So, I mean, these are just a few things that came through my mind. And so the question I hope perhaps you can say a word about is where mid-sized players stand at the moment and what your take is. Could perhaps we start with you, George?
Thank you, Dr. Stopford, Martin. Ladies and gentlemen, good afternoon. My name is George Gouramikalis. I'm the Managing Director of Phoenix Shipping and Trading SA and Chairman and CEO of Blue Wall Shipping Limited. I'll answer all the questions by going back a few years when I started independently from the family business about 27 years ago, where we ran 2 small twin-deckers and did personal relationship banking with a international bank with a branch in Greece that want the personal guarantee and you underwrite everything you had so they give you money. Today, 27 years later, we don't give personal guarantees. We do balance sheet lending. We are still a small to medium-sized company. We have institutional investors. We've done leases. We've taken a company public. We were the first ones to sell out of a public company. We will look at anything there's out there. And what I'm trying to say is very simply that the world has changed. There is available finance out there, to each his own. Not everything is for everybody, and not every asset should be financed in the same manner. Obviously, there are competing forms of finance out there. Leasing, your regular balance sheet, mortgage-backed, non-recourse, meaning personal guarantee non-recourse finance. There are certain European banks which are still active. Some of them are still in Germany, some of them are elsewhere. Even the ones that have been around for a long time, not the Greek banks, which are a special case, but some of the Dutch banks or the German banks that have been doing business in Greece for at least 30 or 40 years and used to do the relationship personal guarantee type of banking, don't do that anymore. They have also graduated to different types of finance. We do have a special case with Greek banks where, for reasons that I sometimes fail to understand, they still like to do personal relationship type of mortgage financing, backed by personal guarantees and usually supported by large deposits in their banks. That is still happening in Greece. I would suspect that over the next few years that will change. But cash is king. That's very important. The cheapest form of finance is own equity. That is true. And I'll just finish off by saying that in 2013, we raised, along with a number of institutional partners, about $140 million of equity. And we co-invested equity only in ships. No debt whatsoever. We decided to lever up about a year and a half later, when values had appreciated, enough so as to keep moderate leverage, very moderate, I would say, something that was actually, in the end, probably below 40%, in order to release equity to further our purchases, again, buying equity only with our next purchases. With the low leverage we had, and with the fact that the balance sheet was cash strong, we managed to get through 2016 without a hitch, and we're very comfortable with our lending banks. And 2017 has brought us back not only to profitability, but to leverage which is probably today below 30%, and being served by, whilst at the same time allowing for positive EBITDA. And I actually hope to be able to have real net profit for 2017 and into 2018. So cash is king. All forms of finance are out there. Not everything's for everybody. We need to pick and choose, but we also need to develop and go to the next stage. Thank you.
Well, I like that. Can we, George number 2,
Yes.
what are you going to say to that slightly bigger group?
Yes. First of all, I agree with George on availability financing. Just 2 words about myself. Like, I'm a business development manager of NJ Ulandris. The company has, at the moment, a diversified fleet of 20 vessels, split between tankers and bulk carriers. My relation with this ship financing comes back to my years as a senior director for the Royal Bank of Scotland. I was there for 15 years. So my opinion is that there is available financing. If you are already on board 2 or 3 banks, coming back to Yves' comment that you have to keep your options open and not counting on just one bank. If you are already on board 2 or 3 banks, you are a healthy company. You have gone 2 or 3 booms and bust cycles. Like I have given a good track record. You have a solid business plan. There is available financing, maybe at a higher cost or at not preferential terms. But I don't think that financing is there just for the masters of the universe. Come with your point. Now, regarding your questions, Martin, regarding IFRS 9, the accounting standards doesn't directly affect shipping or ship owners. It affects the banks that then has a direct, indirect implication to owners. Simple example, you have on your books a loan that has a balloon payment at the end. Simply put, you have a loan that from day one, you know that's not going to be repaid in full. Like it has higher chances of not being repaid. So you have to take provisions every year, probability of default, expected losses for every year. So this affects shipping indirectly. Regarding leasing, of course, as we said, it's not something new. It has been there for many years. For us, as a group, it is attractive, it's flexible, high-profile terms. We as a group don't like high leverage deals. That's why we won't prefer it. But I think it's an attractive means of financing. This is my opening remarks.
Oh, well, thank you. I think
can elaborate.
That's interesting, different perspective on the same issue, because I think because you went very heavily for equity, and you were supporting equity, but were still looking at a debt base from in the traditional sort of banking. Are you actually getting that now?
Yeah. And
Are you able to keep those 3 banks going?
Yes, we're exclusively RBS. And now we're going to the opposite side, we have 7 banks.
Oh, okay. I think I'm going to move on from that point. I don't want to get in there. Dr. Rockett, would you like to introduce yourself and say a few words?
Yes, good afternoon. My name is Kostas Rokos, and I'm the CEO and Chairman of TST International, a company managing and owning bulk carriers with offices in Monaco and New York. This session, I congratulate all the participants in the panels. This conference was very productive. We have seen a lot of different approaches. My particular interest, I should admit, was in the risk management, because I spent a lot of years dealing with risk management, and I was quite impressed by Professor Vorgan. Anyhow, we are here to share our experience as owners, managers of ships, and what we see today, what we have seen in the past, and what we see today, and most probably what we'll see in the future. The truth is that in the previous years, all the stakeholders, the financial stakeholders, faced huge losses, most of them. And as a, let's say, further consideration, they have reduced their books and reduced their positions. Some of them, they have also closed their offices and moved out of Greece. This actually created a harm to the total industry, and I would say that today we experience that the banks and the funds are quite reluctant to enter. They are not convinced yet that they will, let's say, be in good times, and they will get the appreciation of their investment they would like to have. So the most feasible today availability is coming out of the alternative investment. The banks, the LTV, the banks they are looking now with a lot of stringent covenants, they are looking for a LTV about 50% of the total investment. The alternative funds are more aggressive. Of course, they look at the investment as a project and not like what we had in mind in the past as a long life investment. And by that, they are asking high returns. In most of the times, they would like to have two-digit returns. And the question is that feasible today, having in mind what is the market of today and what we predict will be in the future? I would say that this is feasible, and this is a challenge for the good companies to prove that they can do it. Because under these circumstances, a good company with a good investment could create, let's say, as we have seen also in another conference, a decent IRR of 19% in the bulk carrier sector for an old tonnage of 15 years. So I think it's quite feasible to undertake such a debt. And I think that in the near future, this will be the solution for the small and medium ship owners. Regarding the IFRS, I would like to mention that because I have been specialized in the IFRS, I have done studies on that. We have seen that IFRS standards have been overlooked in the past. I was in a conference in 2014, I remember, 13, in Marine Money, and I brought the idea of the going concern. There was a huge company, a big company, ship-owning company, with the remark from the chartered auditors of going concern. And nobody looked at it and overlooked that and invested continuously up to the end of the company. I would say that all these rules are quite useful when you are able to read them. If you are not able to read them, you will make the same mistakes. So at the end, I would like to say for the type of the finance, I fully agree with Bill Karadzias that a traditional ship owner would like and prefer firstly to have an equity partner, as George said also. Secondly, would like to have the bank finance. Then afterwards is the alternative finance, and finally, a Greek ship owner would like, a traditional ship owner would like to have a lease on the ships. Thank you.
So you're boxing the compass. You're having everything, I think.
That's okay.
Well, the last tail end, we got a Norwegian here to do the last bit, and a banker too. So you're in a good position to give yet another perspective. What's your thing?
Thank you. Let me just introduce myself by saying I work at Macquarie Bank in Zurich. We're an Australian firm, the largest infrastructure bank in the world. We're no stranger to asset finance, but we are new entrants to the ship finance business. As Morten has told you briefly earlier today, we've been active in sort of we're not an alternative capital provider like a lot of people bill us. We're a senior mortgage lender. We're doing non-recourse conservative financing to medium to small size ship owners where the capital gap is really pronounced. Macquarie has a history of having looked at the scrap-related financing, so we understand the downside of the transactions we're entering into. And right now is a fantastic time to be lending into liquid collateral shipping businesses, where the earnings cycles are now looking very buoyant and the outlook's good and the asset values are low. Now Martin raised the question about IFRS, and we're very fortunate to be in a situation where we don't have any legacy issues in our bank. And I've worked at other large banking institutions where the issues of marking to market loans and reserving risk capital in relation to loans, that is something we've learned by looking at the market, and we understand what risk we're entering into. So how do we mitigate against that? Well, we're structuring quite conservative transactions, and we're doing it to the liquid collateral classes, and we're pricing it we've talked about this earlier today, pricing it in a way which we think is appropriate. So we're open for business, and this is a market we'd love to work. We've done a few loans in this market. We'd like to do more loans in this market. We think the owners here understand and have a great grasp of the technical aspects of this business, and not to mention they have fantastic track record and history and surviving through the cycles. As a Norwegian, I spoke lightheartedly with Martin about this. The last cycle just gone, the offshore owners in Norway have taken a huge hit, and arguably the Greek owners have sailed through it in a much better position. So we're excited about lending. Mortgage loans, not alternative finance, but mortgage loans structured correctly at right pricing to the Greek market, and happy to speak to anyone.
Well, thanks for that. I think it's an interesting collage of views, because as far as I can see, the first thing you've got to do is get on your bike and find some money somewhere. And the second thing is you've got to make the money fit your company, and you've got to get the bank to sort of come on board as well. And I thought, Mr. Laus's comments about the provisioning, which came through very strongly under IFRS, I guess if you bring the leverage down, this becomes less problematic for the bank. Is this true? I mean, George, you started with a very strong position on equity.
The only reason, if I may, the only reason I started is because we had been burnt in the past by being over-leveraged. So you should learn from your mistakes. We, as many others, at some point, were able to get 80, 85, 90% leverage. Cheap money. I remember paying as little as 100 bips over LIBOR, where today we're paying 400 or 350. And we over-levered. So having been burnt by being over-levered, not being burnt only in terms of have you lost your equity, has your equity been eroded, do you need to restructure, do you need to go sell assets, et cetera, but actually sitting back and saying, okay, what business is more sustainable? Then we went probably to the other side and said, start off equity only and be very measured on leverage.
But if you bring in equity, just a general question to anyone who wants to pick it up. If you bring in equity, everything has a price, which is not just financial, and the price for equity is predominantly non-financial. It becomes potential interference with the business. I mean, somebody, I think this morning, mentioned that in the old days, 30% leverage was typical. And then, of course, I think one of you mentioned 50% as a leverage rate. Was it you, perhaps, Doctor?
Of course.
Where do we stand on this? I mean, if you're going after equity, how do you do it? And how much do you want? And what are you going to have to give away to get it?
Yeah, first of all, I would say that both the owner and the lender would like to have a return. This is obvious, because we do business for money. So each one of us entering into the business assesses the real return with the assumptions coming out of the experience. Because we all have experienced, George, me, more than 25 years. So we have been in most of the recent cycles in the market, and we have experienced the way to weather the cycles. That's why we are here now. Otherwise, we should have been home. So the idea of leverage is important because it maximizes the owner's return, the owner's IRR. The biggest the leverage, the chance to have a higher IRR is obvious. So the owners, first of all, would like high leverage, and particularly in this period is important. Why? Because during the crisis, we have spent all our capital, most of our capital, to sustain our business, because the market the last 4 years was terrible. So we had to inject money from our pocket into the business. So now the available funds are minimum, I would say. So one other reason is that the owners, most of the owners, have spent their capital, and for that reason they would like to get as much as possible on leverage. As I said before, if you choose a liquid asset, I don't say to buy cheap, to buy a liquid asset with proper operational performance, I think at all times you will make money. And I heard also in the previous panel the idea of the smart exploitation. This is also an important key parameter.
I mean, just Fritjof, what's the, presumably you provide equity amongst your many services. How do you, or do you, and how do you do that?
We actually don't do that. We're just doing senior lending. Similar to what Joe Chipula said earlier today, we work with we collaborate with banks, credit funds, private equity funds to put together structures that work for these sort of situations where perhaps there isn't a lot of owner equity left. That's a discussion that we don't necessarily get involved with, but we're all in the same boat trying to make a commercial project work. Break-even rates are challenging, have been very, very challenging the last few years to add top-on financing to. So at Macquarie, one trend that we've seen, and I can disclose here, is that we've worked with quite a number of ship owners that have partnered with private equity. And this is I would say this is it's not new, but there's certainly much more of this type of partnership happening at the equity level, where maybe the private equity owner puts in a little bit more capital than the ship owner, but the ship owner comes with all the commercial, technical, operating experience and services, and there's more of a partnership-based model on the equity side than what there was potentially when the private equity funds entered in 2010, 11, and so forth, and they came in, they speculatively ordered vessels and took these sort of bets. So I think the equity, I think there is a lot of constructive partnerships that's working out on the equity side, which is good for the senior lenders, because you see that the equity investors who are looking for the returns and the owners that are looking to continue building their business and their family generations business, they're working well together. And there are some interesting projects out there for senior lenders now on that basis.
So the equity providers are more able to appreciate the value in a small, well-run company with a great track record than perhaps the other things. Is that a fair point?
I think, Martin, you've studied history, shipping history, and one thing that we fail or we forget is the fact that the roots of modern Greek shipping are that of collecting equity from friends and family. And that meant what? That meant not only collecting equity, but having a fiduciary duty towards your investor, whether that be your cousin or your friend or the guy down the road in your village. And then returning that equity with your returns, having the dividend, and reporting after every trip, every voyage, what you did with the ship. And you can go back to the beginning of the 20th century when you had the usual captain owner with the equity participants. Sometimes the equity participant was also the cargo trader, and that evolved later on to friends and family. And many of the large companies in Greece today, the family-run companies, started off by being smaller equity partners in the older companies and running their vessels together. So what is the difference between that and having a formal institution giving you equity? You have the same fiduciary duty. You're supposed to run your business well. You're supposed to have corporate governance. They had it then. They just didn't call it corporate governance. They reported then. Today we call it corporate governance. You're supposed to act on everybody's interest. You align your interest, etc., etc. Transparency and what have you. So I really don't see why this is such a difficult notion. This is exactly the way we always did it. We just do it in the realities and confines of the 21st century with the various alternative finance methods out there, as opposed to what we did or what our previous generations did 50 and 100 years ago.
Yeah. I think, well, I think what we've teased out is the sort of, the panel seems to have an idea in its mind of the type of framework that might be able to get on its bike and go out and raise money in different ways in today's market. I think it's almost, it must be time for lunch almost. I wonder if there's anybody out there who could take, Yuri, could we take perhaps one intervention, not necessarily a question, but an intervention for someone who's providing capital or who has a comment on this. Yes, there's somebody there. Wait till you get, yes. There it is, yes. Switch it on too, that's always a good idea. think so. Can you hear? Okay, right.
Okay, thank you.
Ah,
It's better now. Thank you. I would like just make a comment. My impression from the presentation made by the distinguished panelists on the issue of finance is that nowadays it is possible to have a shipping finance for anybody who is interested in that, irrespective of the way this, whether this should be traditional finance or would it be leasing or will be finance through credit funds or through equity, etc. And I would like just to have a further confirmation whether my understanding is correct. Thank you.
Yeah, I think that's really a very good way to wind this up. What he's really saying is, do we really believe what we're saying, or is it a load of bullshit? Is that right? I'm not going to take a risk of getting anyone else from the audience in case you. But let's take a straw poll on this. The question is, we've come up with saying really you need a variable model. You need to deal with people who actually are in a position to help people on the financing side who can actually do something with your business structure, and you've got to get the structure to fit. Do we believe that this is true, or is it pie in the sky?
It's not a one size fits all. It's not one size fits all. Okay, there are different ways, different methods for different types of shipping companies, different mentalities. But yes, I'm George Lyo saying that there is available financing, again, for healthy companies that are willing to have a corporate structure. We said before that nowadays it's a relationship with a twist of accounting. I would say it's not just a twist. Nowadays you cannot have any financing if you don't have a proper corporate structure and transparency to the banks, know your customer stuff, register shares and everything. Provided you have all this and you have a good track record with the bank, I think yes, you can have access to finance.
Okay, so we got one yes. That's
Yeah.
good. Incidentally, just on your historic, my impression of having nephews and nieces on the board with big shareholdings is it's not actually any easier than any other sort of finance.
I
right?
agree with you. Exactly.
So, I mean, it's not like this is having difficult equity investors is new.
It's probably harder to have your nephew, niece, or cousin on the board than having an equity
Yeah,
investor.
especially when you're not making much money. Well, okay, so we got one yes. Any volunteers for another yes? Yeah, okay.
I think I agree with caveats.
With caveats.
The caveats, George mentioned some of them. It has to be a good deal, and people have to realize that what they may have gotten 15 years ago is not there today. But there is finance. If they're not crooks, and if they have a good deal, you're laughing, but you will remember that there were many crooks that got finance. So, if they're not crooks, and I say this generally and loosely, I'm not referring to anybody in particular, and you've got a good deal, and you're measured in what you want, you can get finance. You won't get 70%. You might get 30%. It might be more expensive. They might tell you to put the vessel on long-term charter. They might want you to pledge the vessel and God knows what else. But it's there.
So what's our... so, well, should we take just a quickie and then
Yeah,
our
sorry.
banker can have the last word, right?
Okay, so I would like to address something to the bankers, mainly, as a conclusion of my career in shipping. In the past, they loved to do big deals. They loved big tickets, as they used to say. I think that nowadays they should try the opposite. They should try to widen their spectrum, to find more ship owners and lend minimum projects in order to be able to do comparative analysis and finally to know really their clients. Thank you.
I think did you write our policy? We are actually we're agnostic on ticket size. Of course, it's better to spend more your time on a more profitable piece of business. We're in this business for money at the end of the day. But I agree with everything that's been said on the panel, in particular with George. There is capital out there. It's we are not looking to say no to projects so long as they are commercially viable. Expectations are more or less, this is a meeting of minds more than anything, the environment today. And some expectations need to build up to get to, for instance, the terms that we want to offer. So, yeah.
Excellent. Well, I think we have a yes here, and you need to be flexible. You need to understand the people you're raising the money from, and you need to be willing to make some concessions that they will require in order to raise the money, but you can raise funds even for small, mid-sized companies. Is that our conclusion? Well, okay. Well, on that note, can I thank the panelists? I think they've done a fantastic job, and all of you for putting off your dinner. But we're only 25 minutes late. This is not. This is. Okay. So Yuri, are you going to close it or shall I? Oh, okay. Well, on this note, I officially announce the morning session finished. You can go and have a well-earned lunch.
Thank you. Thank you, Martin.